The central bank, really since the turn of the century, has become very active in using monetary policy to try to control the economy and the stock market. And so after the financial crisis, they lowered interest rates to basically 0% on the Fed funds rate. And they embarked on an enormous program of quantitative easing, a fancy way for saying they bought mortgage-backed securities and treasury securities with printed money, effectively. Now, the goal of all this was to get companies to get this money, to borrow this money, to hire people, expand their operations, and the economy would recover. That's not what happened. But it wasn't just the Fed. The blue area here is the Fed. Look at globally, the European Central Bank, the Bank of Japan. Since the financial crisis, almost $12 trillion of quantitative easing has occurred. Now, you don't think that's distorted asset prices, bond prices, equity prices? But did it create the inflation everybody thought it would? No. Look at the CPI. They're struggling to try to keep their target, which that's a whole nother discussion, of 2%. So if there was all this money and it didn't create inflation, where did the money go? Into the asset market. For the most part, corporations borrowed money at extremely low interest rates set by the Fed so they could repurchase their stock. The number one buyer creating demand for stocks have been corporations. Now think about that for a minute. There's a reason they bought their stock back and didn't expand their operations. You think maybe they didn't believe the demand was there? But what does this do, this activity? You're taking a corporate balance sheet and you're basically adding debt and reducing capital. What's going to happen when we go into the next recession? You think any of those companies will be issuing new stock to pay down their debt? And does that make sense? That means that they bought their stock back in the most overvalued market in the history of the stock market, good use of investor money, and they issued stock when they needed to after the crash because they're desperate for money. Again, is that when you want to be issuing stock? Do you know that right now corporations are more leveraged than ever before? And do you know that a large percentage of that is covenant-light debt? And, investment-grade debt rated BBB or higher, the vast majority of investment-grade corporate bonds are rated BBB. So if they have any hiccup at all, they become junk bonds, or as they call it, high-yielding debt. So we had this period since the financial crisis of the Fed creating all this $3.7 trillion of additional liquidity, and the stock market went up. So then what happens when the Fed reverses? So the Fed started raising interest rates. They raised rates 9 times, but only 0.25% each, 2.25%. So the Fed funds rate basically became 2.25%, a range of 2.25 to 2.5. Then they also started letting the quantitative easing assets they purchased roll off their balance sheet. So these bonds that they purchased were sitting on their balance sheet, and previously up to that point, if the bond matured and paid off, then they took that money and they went and they bought more bonds to keep the balance sheet even. Well, they decided that it was time to start reducing the balance sheet. That was previously $800 billion and grew to $4.5 trillion. So they started letting the maturing bonds roll off. And what happened? Anybody remember the fourth quarter of last year? Now look at this. Now the Fed says they're completely independent. They don't listen to the president. They don't listen to the stock market. They're totally independent. In October of last year, Jerome Powell, the new Fed chairman, said, we're a long way from getting rates up to neutral. Neutral being the desired rate that would not hinder growth but also would not create a downturn. 1 month later, no interest rate increase during this time frame. 1 month later, he came out and said, now they see the rates just below neutral. Now remember, the market had started to fall. And they were afraid because the market was falling. In December of last year, the reversal of quantitative easing, called quantitative tightening, was supposedly on autopilot. In other words, they were going to let about $50 billion a month roll off until they felt like there were issues. Guess what? There were issues immediately. So, in March, they said no more rate hikes until things change, and we're going to stop in September of this year the roll-off of the balance sheet. And it doesn't have anything to do with President Trump telling me to lower rates, and it doesn't have anything to do with the stock market falling 20%. We just decided in 3 months to completely reverse course, but it doesn't have anything to do with what the markets did. So if we go into a recession again, what is the Fed going to do now? Their balance sheet is still $3.7 trillion, and interest rates are only 2.25% on the low end. This will be the first thing they do. They're going to return to zero interest rate policy. That's an opinion. And I believe they'll start that sometime this year, the journey back to zero. The next thing, has anybody heard of modern monetary theory? Anyone? Come on, you guys are watching CNBC, aren't you? This is the new brainchild of the new economist, and this is what's going to save the world. You know what modern monetary theory means? It means we can print as much money as we want and it doesn't matter. And the federal government can spend as much as they want and it doesn't matter because we're just going to print it so they can spend it. And that is seriously being considered right now. Listen for the words MMT, modern monetary theory, when you're listening to programs as we go into the next recession. It should scare you. It scares me. This is the Fed balance sheet from right before the financial crisis. They increased from just over $800 billion to $4.5 trillion, and it only took a $600 billion reduction to send the markets into the worst tailspin in the shortest amount of time ever. Now, markets have fallen more, but in a relatively short period of time.